February 2026 opens with a market that looks calm if you know where to look, and dangerous if you know what to ignore. The ICBOF, a U.S. high-yield index option, adjusted spread sits near 2.86%, barely distinguishable from the lows that historically mark late cycle confidence. In public credit, investors are being paid less than 3 percentage points above treasuries to lend to below investment-grade companies. By the standards of the past 3 decades, that is not caution, it is trust. That trust is visible in the mechanics of the spread itself. Option-adjusted spreads exist to strip out the value of embedded call options and isolate pure credit risk. When OAS is tight, it tells us that investors are not demanding compensation for volatility, refinancing uncertainty, or default. In effect, the market is saying that downside risk is either remote or manageable. The problem is not that this judgment is obviously wrong in public markets. The problem is that public markets no longer sit at the center of the credit system. Over the last decade, and especially since 2020, credit creation has migrated away from banks and toward non-bank lenders. Private credit funds, direct lenders, non-traded BDC, interval funds, and semi-liquid vehicles now provide trillions of dollars of financing to middle-market companies, real estate projects, infrastructure, and increasingly, technology and AI-linked assets. These structures do not price risk continuously. They price it episodically through models, appraisals, and committee judgments. In quiet periods, that distinction barely matters. In stress, it becomes everything. The tightness of public high-yield spreads in February 2026 therefore masks a structural decoupling. Public benchmarks are signaling stability, while private credit plumbing is under strain. This is not a contradiction, it is a lag. Public spreads measure the marginal cost of capital for liquid bonds. Private credit measures the durability of trust in opaque balance sheets. Liquidity mismatch sits at the heart of this tension. Many private credit vehicles hold assets that cannot be sold quickly without meaningful price concessions. Loans are bespoke, documentation is complex, and secondary markets are thin. Yet the liabilities funding these assets increasingly promise periodic liquidity. Quarterly redemptions, monthly windows, in some cases, daily subscriptions and redemptions backed by a thin sleeve of public securities. The promise is not unlimited liquidity, but it is enough to create expectations that assets can be exited near stated net asset value. NAV in these vehicles is not a market price. It is a model output. It is an estimate constructed from assumptions about borrower performance, discount rates, recovery values, and comparables. In stable conditions, those assumptions move slowly. NAV appears smooth, predictable, almost bond-like. But when liquidity is demanded rather than offered, the realizable value of those same assets can diverge sharply from the model. Discounts of 15 to 25% are not unusual in forced secondary sales. That gap is the fault line. Gates are designed to protect against that fault line breaking open. Redemption limits, queues, lockups, and run-off provisions slow the pace of withdrawals, so managers are not forced into fire sales. In theory, this is prudent liquidity management. In practice, gates are also information events. The moment a fund tightens redemptions, it signals that liquidity is scarcer than investors believed. That signal can travel faster than the actual cash flows, prompting investors to submit redemption requests preemptively before conditions worsen. The last 2 years have offered real-world demonstrations. Non-traded rates like Starwood faced billions in redemption requests, drew on credit lines, and then gated sharply. Blue Owl's attempted merger between a non-traded private credit BDC and a listed vehicle collapsed under scrutiny of NAV integrity and liquidity terms. In each case, the underlying assets did not suddenly default en masse. What failed first was confidence in the wrapper. This is why the most dangerous scenario in February 2026 is not gradual spread widening. It is the sudden freeze. A sudden freeze is not a slow repricing. It is a discontinuity. Transactions stop not because assets are worthless, but because no one trusts the marks, the liquidity, or the counterparties. One high-profile failure can be enough. The mechanism is psychological but grounded in structure. Opacity is tolerated when nothing goes wrong. It becomes intolerable the moment something does. A single fund revealing a large NAV write-down, a fraud, or a visibly distressed merger exposes the possibility that similar problems exist elsewhere. Investors do not wait for proof, they extrapolate. Redemption requests rise across vehicles that share the same structural features. Gates engage. Secondary markets thin further, prices gap down, new lending halts. Borrowers who relied on rollover financing discover that liquidity has vanished overnight. This dynamic has historical precedents. The repo market in 2007 did not unwind slowly, it froze. Archegos did not unwind gradually. It collapsed when margin confidence broke. Gated real estate funds in multiple cycles did not fail because buildings disappeared, but because liquidity promises collided with illiquid reality. The difference in 2026 is scale. Private credit is no longer a niche, it is a pillar. The public high yield spread does not capture this risk in real time. It will react after the fact, once forced selling, refinancing failures, and contagion reach liquid markets. By then, the damage is already done. Tight spreads today are not proof that the system is safe. They are evidence that the system has not yet been tested. February 2026 is therefore a moment of deceptive calm. The surface is smooth. Beneath it, the architecture depends on confidence, model-based valuations, and liquidity assumptions that have never been stress-tested at this scale. The question is not whether private credit contains risk. All credit does. The question is whether the system can absorb a loss of trust without seizing up. History suggests that when liquidity is promised but cannot be delivered, trust breaks suddenly, not slowly. To understand why this fragility matters now, it is necessary to look beyond the wrapper and into the borrowers themselves. Credit cycles do not break because investors panic in a vacuum. They break because underlying cash flows can no longer support the debt structure built on top of them. In 2026, that pressure is becoming visible across private credit portfolios, even as headline default rates remain deceptively low. The most important metric is not defaults as traditionally defined, but free cash flow. According to IMF data cited in late 2025, roughly 40% of private credit borrowers are now operating with negative free cash flow. That means they cannot service interest from operations alone. They rely on refinancing, covenant flexibility, sponsor support, or accounting mechanisms that defer cash obligations into the future. In a benign liquidity environment, those tools can extend survivability for years. In a tightening one, they accelerate collapse. Interest coverage ratios tell the same story. Average coverage in private credit has fallen toward 2 times. That is a thin margin. A modest revenue shock, a cost increase, or a refinancing at higher spreads is enough to push coverage below 1. At that point, debt service is no longer sustainable without restructuring. Public markets tend to price this risk earlier, through widening spreads and falling prices. Private markets absorb it quietly, through amendments. The most common amendment tool in this cycle is payment, in kind interest. PAK allows borrowers to capitalize interest rather than pay it in cash. On paper, this avoids default. In reality, it increases leverage and compounds risk. Debt grows while cash generation does not. PAK was once confined to mezzanine tranches and special situations. By early 2026, it accounts for a meaningful share of income in public BDC and appears increasingly in senior secured loans. That shift is not a sign of innovation. It is a sign of stress being postponed. Liability management exercises play a similar role. Through distressed exchanges, maturity extensions, and priming transactions, borrowers avoid formal bankruptcy while transferring value away from existing lenders. Headline: default statistics remain low because legal default is avoided. The economic reality, however, is impairment. When these exercises become widespread, the distinction between performing and non-performing blurs. Investors rely even more heavily on internal marks to maintain NAV stability. This is where valuation transparency becomes systemic. Level 3 assets, by definition, lack observable prices. They depend on managerial judgment. In good times, that judgment is rarely challenged. In bad times, it becomes the focal point of distrust. The BlackRock TCP Capital episode in early 2026 crystallized this risk. A nearly 20% NAV decline in a single quarter, following a year of earlier write-downs, raised uncomfortable questions about how long deteriorating credits had been carried at optimistic values. Litigation transformed those questions into public accusations. Allegations that NAV were not timely or appropriately marked do more than threaten a single firm. They cast doubt on the entire marking ecosystem. The cockroach theory applies with particular force in private credit. When one problem becomes visible, investors assume others remain hidden. Whether that assumption is fair matters less than whether it is believed. Belief drives flows, and flows drive liquidity. In a system where assets cannot be sold quickly, even modest redemption pressure can overwhelm available buffers. Fourth quarter 2025 data already showed redemption requests in major non-traded BDC approaching their quarterly limits. Those levels are not catastrophic on their own. They become dangerous when combined with a narrative of mispricing. Retailization amplifies this dynamic. Semi-liquid wrappers have brought private credit to a broader investor base, including wealth management channels accustomed to daily liquidity. Education around gates and queues exists, but experience does not. When investors encounter their first pro rata redemption or delayed payout, the reaction is often not patience, but urgency. Redemption requests rise not because fundamentals suddenly worsened, but because expectations were violated. The sudden freeze scenario formalizes this intuition. It begins with an idiosyncratic event, a large NAV write-down, a failed merger, a fraud, or a visible gating decision. That event acts as information, not about one fund, but about the category. Investors reassess the probability that their own vehicle might face similar stress. Redemption requests spike across managers simultaneously. Managers respond rationally. They slow liquidity, activate gates, and conserve cash. Secondary markets already thin become one-sided. Discounts widen. NAV fall as realized prices replace models. Those NAV declines validate the initial fear, prompting further redemption attempts once windows reopen. New origination stops. Borrowers that depended on refinancing discover that capital is unavailable at any price. This is not merely a private credit problem. The non-bank lending ecosystem is deeply interconnected with the traditional financial system. Banks fund private credit through warehouse lines, subscription facilities, and NAV loans. They also transfer risk through synthetic securitizations known as significant risk transfers. In these structures, private credit funds absorb first loss exposure from bank loan portfolios in exchange for fees and yield. In normal times, this arrangement appears efficient. Banks free up capital, funds earn attractive returns. In stress, it becomes a transmission channel. If private credit funds face liquidity pressure, they may be unable or unwilling to roll SRT positions. Risk flows back onto bank balance sheets precisely when asset quality is deteriorating. At the same time, banks are likely to pull funding lines to protect their own liquidity ratios. The feedback loop tightens. The result is a freeze that spreads horizontally and vertically. Horizontally, across private credit managers facing similar structural constraints. Vertically into banks, insurers, and pension funds with exposure to the same assets or funding relationships. Public high yield spreads eventually respond, but by then they are reflecting damage already incurred. Sector concentration adds another layer of vulnerability. Healthcare has emerged as a leading source of non-accruals, pressured by labor costs and reimbursement dynamics. Commercial real estate remains a gray swan, vulnerable not just to slow valuation erosion, but to sudden confidence shocks in financing vehicles. AI-linked infrastructure introduces a newer risk, capital intensity justified by optimistic demand assumptions. If those assumptions falter, debt structures built on them may prove fragile. Regulators are aware of these risks, but awareness does not equate to control. Liquidity management reforms proposed by IOSCO and national regulators aim to improve disclosure and stress testing. Basel Roman IV tightens oversight of bank risk transfers. These measures may reduce opacity at the margin. They do not change the fundamental reality that non-bank lending lacks a lender of last resort and deposit insurance. Trust is the only anchor. That is why February 2026 feels less like a turning point and more like a test. The system is not visibly broken, it is stretched. Public markets signal calm. Private structures rely on confidence that has not yet been withdrawn. The defining question is whether that confidence can withstand the next shock, or whether it will fail abruptly, transforming isolated stress into a systemic freeze. The mathematics of a freeze are deceptively simple. Liquidity does not disappear gradually. It collapses once confidence crosses a threshold. In a non-bank system built on discretionary funding and voluntary rollover, that threshold is lower than most models assume. Investors do not need certainty of loss to withdraw. They need only uncertainty about valuation and access. In formal terms, liquidity in the private credit system is a function of confidence multiplied by time. As long as investors believe they can exit later, they are willing to stay today. The moment that belief weakens, time compresses. Everyone tries to move at once. Gates delay the exit, but they also confirm the fear that exit will be harder tomorrow than it is today. The rational response becomes acceleration, not patience. This dynamic explains why freezes are fast. They are coordination failures. Each individual investor may prefer an orderly unwind, but no one trusts others to behave that way. Redemption requests become a dominant strategy. The system shifts from equilibrium to discontinuity. In February 2026, the ingredients for such a shift are present. Borrower fundamentals are weakening beneath the surface. PIK usage and liability management exercises are masking distress rather than resolving it. Valuation credibility has been damaged by visible write-downs and litigation. Redemption pressure is rising in vehicles explicitly designed to manage it. And the funding architecture connecting private credit to banks is procyclical, not stabilizing. What is missing is a catalyst. Catalysts are by definition unpredictable. They are often banal in isolation. A single fund announcing an unexpected NAV adjustment. A high-profile sponsor walking away from support. A regulatory inquiry that reframes a known issue as a systemic one. When they occur, they retroactively seem inevitable. Beforehand, they look trivial. This is why reliance on public indicators alone is dangerous. The ICBOF, a U.S. high-yield OAS, remains tight, not because private credit is healthy, but because public markets are insulated until they are not. High-yield bonds trade continuously, benefit from dealer intermediation, and price information rapidly. Private loans do not. When the private system stalls, public spreads widen abruptly as forced sellers emerge and refinancing windows close. The lag between private stress and public repricing is not a comfort, it is a warning. Historically, the most violent spread moves occur when liquidity evaporates. not when fundamentals deteriorate gradually. By the time public spreads reflect stress, the opportunity to manage risk has already passed. From a systemic perspective, the absence of a lender of last resort in non-bank credit is decisive. Banks can rely on central bank facilities and insured deposits. Money market funds have implicit backstops. Private credit funds have gates and hope. In a freeze, hope is not a funding source. Without external support, the only way to meet obligations is asset sales, and asset sales into illiquid markets destroy value. The interconnections ensure that this destruction does not remain contained. Insurance companies and pensions hold private credit directly or through funds. They use leverage, derivatives, and reinsurance structures that assume stable valuations. A sudden markdown triggers collateral calls and portfolio rebalancing. Banks, seeing asset values fall and funding risk rise, retreat further. What began as a confidence event in one corner of the market becomes a generalized tightening of financial conditions. Sectoral exposure determines where cracks appear first. Healthcare faces structural margin pressure. Commercial real estate faces secular demand shifts layered onto refinancing risk. Technology and AI infrastructure face valuation risk if expected productivity gains lag capital intensity. None of these sectors need to collapse for the system to freeze. They only need to disappoint simultaneously enough to strain trust. Regulatory responses in early 2026 are reactive by design. Liquidity bucketing, enhanced disclosure, and stress testing improve transparency at the margin. They do not create liquidity. Basel Roman IV scrutiny of significant risk transfers reduces regulatory arbitrage, but may also accelerate deleveraging if banks retreat from partnerships with private funds. In the middle of a confidence shock, regulatory tightening can amplify contraction rather than contain it. For investors, the implication is not to predict the freeze, but to recognize its asymmetry. Upside in a mature credit cycle is incremental. Downside when confidence breaks is abrupt. Structures that appear stable under model assumptions behave differently under redemption pressure. The distinction between locked capital and promised liquidity matters more than incremental yield. February 2026, then, is not defined by momentum. It is defined by judgment. Public markets reward complacency until they punish it. Private markets reward trust until they withdraw it. The transition between those states is not linear. The sudden freeze remains a tail risk, but it is a fat tail. It does not require a recession, a rate shock, or a collapse in earnings. It requires a loss of belief that stated values can be realized when needed. Once that belief erodes, the mechanics take over. History suggests that systems built on confidence tend to fail at their strongest point, not their weakest. They fail when participants have the most to lose from being last. Tight spreads, smooth NAV, and abundant wrappers are not signs of resilience. They are signs of alignment around a fragile assumption that liquidity will be there when called. Whether that assumption holds through 2026 will determine whether private credit completes its first full cycle intact, or whether it discovers abruptly the cost of promising liquidity on assets that were never designed to provide it. What ultimately decides the outcome is not data, but behavior under stress. Credit systems fail when participants stop believing that the rules they relied on yesterday will be honored tomorrow. In 2026, private credit sits precisely at that behavioral edge. The contracts still work, the gates still exist, the models still run. What is in question is whether investors will continue to accept them once friction becomes visible. The defining feature of this cycle is that losses are not evenly distributed. They are clustered, delayed, and then revealed suddenly. PIK interest, maturity extensions, and covenant-light documentation have not eliminated risk. They have concentrated it in the future. When that future arrives, adjustments do not happen one loan at a time. They happen through portfolio-level reappraisals, NAV gap. Confidence reprices discreetly. This creates a paradox. The longer the system avoids a reckoning, the more severe the eventual adjustment becomes. Smooth performance encourages leverage, retail inflows, and structural experimentation. Each layer added in calm conditions increases sensitivity to a shock. By early 2026, private credit has accumulated all three. For allocators, the critical mistake is to confuse diversification of managers with diversification of structure. Many funds differ in branding, strategy labels, or sector emphasis, but share the same liquidity promises, valuation methods, and funding dependencies. In a sudden freeze, those similarities dominate. Correlation converges toward one not because assets are identical, but because redemption mechanics are. The same applies to risk models. Stress tests typically assume orderly outflows, partial market liquidity, and staggered defaults. A sudden freeze violates those assumptions. Outflows are front-loaded. Liquidity evaporates simultaneously. Defaults cluster as refinancing windows close. Models calibrated on gradualism understate the speed and depth of drawdowns. The banking system's role reinforces this nonlinearity. Banks have learned from past crises to protect their own balance sheets first. In a confidence shock, they do not wait for losses to materialize. They pull funding lines, tighten terms, and conserve capital. For private credit funds dependent on warehouse financing or subscription lines, this behavior transforms a liquidity issue into a solvency one. The bridge disappears while it is still being crossed. At that point, policy options narrow. Central banks can support banks and public markets. They cannot directly lend to private funds without explicit mandates. Regulators can encourage forbearance, but they cannot force investors to provide capital. The system must absorb the shock internally through asset sales, restructurings, and value transfer. This is why the sudden freeze is best understood as a confidence crisis rather than a credit crisis. Credit deterioration sets the stage, but trust withdrawal pulls the trigger. The distinction matters because confidence is reflexive. Once lost, it is difficult to restore quickly. Even funds with strong underwriting and conservative structures suffer because they operate within the same ecosystem. The comparison to earlier episodes is instructive. In 2007, subprime losses were initially contained. The freeze came when counterparties stopped trusting each other's balance sheets. In 2020, the dash for cash froze treasury markets until policy intervention restored liquidity. In each case, the severity of the freeze exceeded what fundamentals alone would justify. Private credit in 2026 lacks the safety valves that resolve those episodes. There is no standing facility to absorb illiquid loans. There is no transparent price discovery mechanism to restore confidence quickly. Recovery, if a freeze occurs, would be slow and uneven, favoring investors with locked capital and disadvantaging those reliant on liquidity promises. This asymmetry reframes the debate about opportunity. High yields and tight spreads are often interpreted as signals to allocate. In late cycle environments, they can be signals to interrogate structure instead. The question is not whether assets are attractive in isolation, but whether they can be held through stress without forced action. For managers, survival depends on credibility. Those who marked conservatively, limited liquidity promises, and resisted leverage will face redemptions, but may retain trust. Those who optimized for growth, smooth returns, and marketing appeal may discover that confidence, once broken, cannot be marketed back into existence. February 2026, therefore, represents a hinge. The system can continue functioning if confidence holds, refinancing remains available, and isolated losses are absorbed quietly. Or it can tip into a sudden freeze if one event convinces investors that marks cannot be trusted and liquidity is conditional. Both paths are plausible. Only one is stable. The warning embedded in tight public spreads is subtle. They tell us not that risk is absent, but that it is being priced elsewhere. When risk migrates from transparent markets to opaque ones, volatility does not disappear. It accumulates. The release, when it comes, is abrupt. In that sense, the current moment is less about forecasting collapse than about recognizing fragility. Private credit does not need to implode to reshape the cycle. A pause in origination, a tightening of liquidity terms, or a repricing of trust would be enough to slow growth, pressure borrowers, and feed back into public markets. The sudden freeze is not destiny. It is a conditional outcome embedded in the structure of the system. Whether it materializes depends on behavior, not belief. Systems built on confidence are stable until they are not. When they fail, they do so without warning, and usually when participants are most convinced that stability has returned. That is the risk profile of February 2026. Calm on the surface, strain underneath. A system balanced not on fundamentals alone, but on trust in marks, wrappers, and liquidity, promises that have yet to be tested at scale. If confidence holds, the cycle extends. If it breaks, it will not do so gradually.